Hello everybody! Today we're going to talk about something called the long put vertical, what it is and how we set it up. So in this case, what we're looking at is a stock where it's been tanking for the last couple of months. What a long put vertical wants to happen is we want it to continue downwards. Long put vertical means we're betting the stock price continues downwards. So how do we set this thing up? Well, I've already set it up for us. The stock price here you'll see is 363 and change. The way we set up a long put vertical is we always buy a put just above the stock price and then sell a put just below the stock price. Meaning the stock price should always be between our two strikes. We're buying one above, we're buying one below. And again, we can make this as wide or as narrow as possible. In this case, it can't get any more narrow, it's $1 width. But this could easily be like 370 to 360, etc. As long as the bought strike is above the stock price and the sold strike is below the stock price, this is a perfectly good trade. So, what does this mean? Well, because this is $1 wide, which is the 364 to 363 strikes, max potential profit plus max potential loss always has to equal the width of the strikes. So in this case, if we're paying 42 cents for it, whatever we pay for it is the most we can lose. That means this has to add up to $1. That means 58 cents has to be the max potential profit. Again, $1 width, because this is $1 wide, 364 to 363. We are paying 42 cents for this vertical, which is the most we can lose, which is we can only lose what we pay for it. So 42 cents is the most we can lose. In order to make the 42 add up to $1, that means 58 cents is the most we can win, because max potential loss plus max potential profit has to equal the width of the strikes. So that is what a long put vertical is and how to set them up.